Hey everyone, now diversification or concentration. Spread your risk over a range of investments or double down on just a few. Investing in 2021 and beyond feels a bit uncertain, there's no doubt about that, but it shouldn't be something that you avoid doing altogether, providing you have some sort of strategy to work with. So that's what I'm going to be covering today. Now, if you're new to the channel, I cover a whole range of topics from investing in managed funds, property, shares, crypto, you name it. Nothing's off limits. So if you're into that sort of thing, then make sure that you subscribe and give this video a thumbs up if you get something out of it. Now, diversification or concentration. To be honest, I'm not convinced it's really an either or type thing here. You'll naturally gravitate towards one or the other extreme, and that's totally fine. But I think it's pretty important to understand what your own style of investing is so that you can move forward with confidence. The difference between these two strategies can be pretty obvious, or they can be quite subtle. With concentration, your faith is in your investments. But with diversification, you believe more in the compounding growth effect of being in the market long term. The years immediately following 2019 will likely go down in history as one of the weirdest times ever, especially in the property market and share markets globally. How in the world can economies shut down for prolonged periods of time, yet nothing pulls the markets down? How can this make sense? And why on earth would I want to invest in anything right now when it all feels so inflated? Now, if this is something that worries you to the point where it stops you from investing, then let's start with defining diversification. What does it mean? Simply put, you have many eggs, a bunch of baskets. There you go. That's diversification. You don't know what the future holds, so you take a bob each way. Now, some say this is what we should all do, so there's no point aiming for better because statistically, you just can't get it. The market is said to be efficient. In other words, the price that you pay for any investment takes into account all known information. We call this the efficient market hypothesis, and by extension, the theory states it's impossible, especially in the long term, to get a return that's better than the average. Put more technically though, diversification is a strategy that maximizes the return that you can get from investing for a given level of risk. So in your investment portfolio, which is really just a collection of different types of investments, each component moves in price at different rates and sometimes in different directions too. We call this negative covariance. And it's the secret formula, if you like, that gives investors the right to get a good return and manage the overall level of risk or volatility. Now, this thing called volatility, think of it as just the movement of price relative to the average. Generally speaking, the higher the level of volatility or range in movement in price, the more likely you'll see strong returns, in the long term anyway. So return and volatility, they're kind of a package deal. It's still not nice though, having to deal with the ups and downs along the way if you're trying to reach a goal with certainty. So through diversification, you're adding more investments into the mix to settle things down a little bit. Yes, you lose some potential return, but ideally not too much in the process. Let's take an umbrella business as an example. Some years you're killing it, and some you're not. It all depends on something that you can't control, the weather. You have a volatile investment here. What about an ice cream business? Same thing really. A situation beyond your control, weather, can either make or break you. Owning one business is volatile, but if you have a lot of skin in the game, a larger portion of your wealth is exposed to a potential payoff. Now, what about if we diversify just a little bit? Let's take these two businesses and let's jam them together to see what happens. As they move in performance opposite to each other, or they're negatively correlated, this shows us how it's possible to sacrifice a small amount of return for much less uncertainty around performance. You've halved your investment in each one of these businesses, yes, but you've reduced your volatility significantly. Now, what about some examples of diversification? Managed funds has to be the simplest to understand. Remember, if you have KiwiSaver here in New Zealand, you have a managed fund. The fund manager is given the job of maximizing the return on your behalf for the level of risk that you're comfortable with taking. Outside of KiwiSaver, perhaps you invest in an exchange-traded fund or an index fund. Same thing, all they're doing is blending investments between a range of options to mellow out volatility while providing a return that hopefully you're happy with. Now, of course, diversification happens not just with managed funds. Let's say you own an investment property. You have KiwiSaver, which gives you access to international markets, and you may choose to invest directly into a handful of companies here in New Zealand and Australia. A diversified, long-term strategy of investing a similar amount over time or dollar cost averaging is a super powerful thing though. And it's simple. Whatever the market return is over time, compounded, does all the heavy lifting for you. Now, if diversification is about putting faith in the market, being concentrated is all about putting faith in a specific company, a sector, or a strategy, ideally that you know well. So the fewer investments you hold, the more concentrated you are. Your investment portfolio maybe looks a bit basic as there's not much in it, but what is in it belongs there. You've done the work researching and you intuitively get it. And perhaps you see something that others have ignored. You don't believe the market is efficient at all. In fact, sometimes it flat out just makes mistakes. You don't have to settle for the average here because you're operating with a degree of faith that others don't possess. Every time you proceed as a concentrated investor, you're moving ahead with high levels of conviction, knowing that you've stacked the odds somewhat in your favor. Now, if you want to check out an awesome video I did with Cole Hopfure on this exact topic, check out the link in the notes. But at this point, you're perhaps identifying with being either a concentrator or a diversifier. The great thing with investing is that it's full of space to adopt almost any strategy that you want and have success with it. Now, I mentioned before that diversification and concentration kind of sit on a spectrum, but they also don't really, because you can fold in elements of each one into the other. This is what I call diverse-centration. What do I mean by this? Well, let me give you two examples. First is the rear view mirror approach. This is where when you look forward, you can see diversification in almost anything. But when you look behind you, you see more concentration. Say you're investing in one company only. On the board, there's diversity. They may have thousands of individual employees spread out all over the world with multiple product lines and distribute product in multiple markets. But when you zoom out, it's still only one investment. Now, let's say you're a property investor who owns commercial property, residential, and industrial property. You zoom out and it's all property. Or lastly, you have all the usual investments like cash, bonds, property, infrastructure, and shares. Seems like you're pretty well diversified, but here also, when you zoom out, all of your investments are denominated in dollars, a pretty concentrated investment. Now, what strategy could you use to diversify out of dollars? So it's possible to have a degree of diversification no matter where you sit globally on the spectrum. The second example is something though called the core satellite approach. Again, in the notes will be a link to this video on your screen if you want to check out a little bit more detail on this topic. The condensed version though of what it is, well, you have a portfolio of investments which is segmented off and divided into a core and several satellites, a big chunk and a few smaller chunks. Let's say, for illustrative purposes only, that your core consists of 70% overall. In your core, you may wish to insert some pretty well diversified investments like KiwiSaver or some other types of managed funds. This gives you the return that the market provides, compounded over time. The goal is to get a good return appropriate for the risk that you're taking, and ideally, you don't want to pay too much for the privilege. That's the general idea. Now, this may sound great to some of you hearing this. In fact, some of you may wish to put 100% of your portfolio into core type investments, not just 70%. To others though, I'm guessing you're possibly thinking, there's no fun in just owning the market, or it's not really that engaging, is it? For you, this is where the core satellite approach ensures that these 100%ers can never say that they told you so, because the majority of what you're investing in also is just like them. The satellite components, though, allow you to exercise your intellect, and it gives you space to really get your hands dirty. Let's say you divide this into 4 components. Out of the 30%, half of that, or 15%, invested in residential investment property. 5% in mortgage reduction. Maybe 5% is allocated towards 1 or 2 individual companies that you know well, and maybe 5% is invested in crypto assets. Great if you decide to diversify your denominator. Now, these smaller satellites allow you to be a hunter for what you really like to target, but your core diet relies on what's available by grazing in the market. Now, you would have spotted that I included debt repayment as an investment component in one of the satellites. This isn't conventional, but I often suggest looking at debt repayment as a risk-free investment, which, because it's risk-free, has the effect of reducing your overall portfolio risk substantially. Now, when we're investing in an uncertain environment like what we're in right now, or when we ourselves are uncertain, the most logical step to take is diversification. When there's certainty in the environment, or we ourselves are certain our strategy is right, a move towards concentration might make more sense. Still, like everything, invest as you are and resist the temptation to try on someone else's ideas without fully getting it yourself first. Now, to bring this in for a landing, there's a few final thoughts I want to leave you with. Firstly, when you're investing, you want to have a goal, but after that, just having a strategy of some sort is really, really important. If the goal is the object to aim at, the strategy is your game plan, which makes it easier to focus on the outcomes rather than just the tools that you're building with. If you started investing a little ad hoc and you didn't really know what you were doing when you made a start, don't worry. A great move you can make though now is to create even just a template of a core satellite portfolio that you'd like to move towards. Now, when you invest with a fund manager, you're paying a fee so you don't have to think about any of this. But if you're doing this alone, the other thought to give you here is this: why not pay for some independent advice? A lot of advisors now offer guidance for self-directed investors and may be able to assist you in developing a strategy that works well for you. Lastly, I cannot stress just how important it is to consider diversification of the denominator. There's no point maxing out your return while keeping a lid on risk when you haven't diversified the store of wealth that all mainstream investments convert to in the end, our dollars. Even just a small amount of your overall portfolio allocated towards physical precious metals and digital assets like Bitcoin can make a massive difference to overall portfolio performance. Righto, well done if you've made it this far. Now, if you got something out of this, please consider subscribing and leaving your thumbs up so I can reach more people with this sort of stuff. And while I can't offer up specific financial advice on YouTube, please feel free to leave a comment with an idea of what I can cover off in future videos. That's it for me. Catch you next time.